It is Tuesday the 25th of February 2020, and in this video I'm going to be taking a quick look at the S&P 500 or the US markets, which of course came down fairly heavily yesterday, so I'm going to be talking a bit about that. We're going to take a fleeting glance at crude oil. We had a question about that, and also a quick look at a composite model line, and I'm going to answer a question that came up in the community about the composite model line. So let's get started. First of all, the S&P 500, as you can see, came down quite heavily yesterday. Now, in the video that I recorded on Saturday, I spoke about this being a D category interaction. We were coming down into the 40-day cycle trough on the assumption that the 20-week cycle trough had formed here on the 31st of January. So what has happened? Well, because of the strong move down on Monday, yesterday, the analysis has changed. And I think what we should do is go and take a look at the 3-month view. There we go. And let's discuss the change in the analysis. Because of this really strong move down, the analysis part of Sentient Trader has said, well, that doesn't look like a move down into a 40-day cycle trough following a 20-week cycle trough. So therefore, it is more likely that the 20-week cycle trough is what this price is now moving down into. So looking at it, that does make some sense. In terms of our trading, what was a D category interaction, or what was probably a D category interaction, is now an F category interaction. Of course, it's still a short trading opportunity. It's a short trading opportunity that we missed in this case because the market really suddenly dropped so quickly. I would like to point out that although indeed it is possible that the 20-week cycle trough still lies ahead of us, the bigger danger, in my opinion, is that this was the 20-week cycle trough, and I wouldn't be surprised as time passes to find that the analysis goes back to the 20-week cycle trough in this position over here. If that is the case, then that means that this is the move down into the 40-day cycle trough. So why such a strong move down? Well, because we must bear in mind the sort of overarching consideration, something that I've been discussing in the market updates that I've been doing and so forth, and that's shown in the overview chart, which is that in the middle of this year we have a big trough. Whether it's a 54-month cycle trough or an 18-month cycle trough, I'm not absolutely sure, and I'm not going to spend time discussing it in detail here, although it is probably something that we do need to discuss fairly soon. But nevertheless, we're expecting a move down into the middle of the year. And if you take a look at recent market updates, I've mentioned it, we're looking at bearishness beginning to appear in this market. It's been very bullish, as you can see. It's been going up for, how long is that? For over a year. And so it has been very bullish. We've been waiting for signs of bearishness. And what happened yesterday is exactly that. It is a sign of bearishness. And so whether the 20-week cycle trough lies behind us or whether it's lying still ahead of us is a little uncertain. I would be careful of the fact that it might lie behind us. What's going to happen next? Well, of course, price is going to come back again. As you can see, according to this, it would be a G category interaction, which means that we wouldn't be interested in a long trade. It tells us to consider an early A category interaction, assuming that the 20-week cycle trough is still ahead of us or is about to form. So as price bounces back up again, we need to watch it very carefully. The important thing is that the bearishness that I've mentioned in several previous market updates, has not arrived. I've kept saying this market is still bullish, still a bullish market, and we've seen no signs of bearishness. Well, now we have seen a sign of bearishness, and that is fairly worrying. Look at this composite model line. The composite model line on the 3-month chart is definitely heading down over the next 6 weeks or so. So we now need to be on our toes, because it could be that the market is turning bearish. the bigger picture in terms of what we're expecting this year, as I've said in many of the market updates, is that we're looking for price to come down into a trough in the middle of the year. If there's going to be a trough in the middle of the year, then of course price needs to move downwards. So I'd be a little cautious about jumping into long trades prematurely. Let's take a quick look at crude oil. We had a question in the community about crude oil. Yes, I believe that the 20-week cycle trough formed here at the beginning of February. You can see that's a 20-week cycle trough. Here's our A category interaction. But now it's worth pointing out that that A category interaction has been fulfilled. Okay, so we had a 20-week cycle trough forming, in my opinion, and price has bounced up. It's crossed above the FLD. It's met its target for the A category interaction. It's now back at the FLD. This is a critical moment for oil because we would expect this to be a B category interaction and then a bit more of a move up in the C category interaction. But I'd like to point out, you can see this composite model line is not really particularly bullish. You know, it's sort of flatlining pretty much at about $55. So is this as exciting as it could be, the fact that a 20-week cycle trough has formed? No, it's not, because again, we need to consider the bigger picture. And here on the 3-month view, you can see a slightly bigger picture. And look at the shape of this cycle here into the 80-day cycle trough that is now expected at the beginning of April. It's a very neutral shape, and certainly not, you know, a tremendously exciting bounce out of the 20-week cycle trough. Why is that? Well, there's a clue here with this whisker for the 18-month cycle, which is sneaking in, because crude oil is still, in my opinion, moving down into a much bigger trough. So a similar situation to the situation we're in with stock markets. Because there's a big trough looming ahead of us, we need the market to still come down further. And here is the overview of crude oil, and you can see we're looking at a 54-month cycle trough, or certainly a big cycle trough, at least 18-month magnitude. You probably know that when it comes to positioning 54-month cycles, I like to hedge my bets a little bit. I don't take them too seriously. You know, is it possible that the 54-month cycle trough occurred here or here? Yes, it is possible. So we're coming into a trough of at least 18-month magnitude, and so when you're looking for the M shape, you know, that's the M shape. The bottom line is that we're still expecting the market to come down lower into about the middle of the year. So again, the fact that it's bounced out of a 20-week cycle trough might not be all that exciting, because we are still expecting a deeper trough to form. And let's wrap up this video. There's been a thread on the community about the composite model line. This is an analysis of gold, and you can take a look at the thread and read a little more about it. We started off, or I think his name is Anthony, who posted this chart. Started off with an analysis of gold. It was a trough-based analysis. I pointed out that, in my opinion, gold works a little better with a peak-based analysis, and so then we had a combination of both. And on the analysis was a composite model line. I suggested turning off sigma L from the composite model line. And this is the result. So this dashed yellow line is the composite model line. And so there are a few things to say. There's actually quite a lot to say about this. First of all, the composite model line shows what the analysis is telling us. And because we have both a trough and a peak analysis here, when you turn off sigma L is the sum of all the longer cycles, which also includes all unknown elements. So several things to say. First of all, price should probably be displayed on a logarithmic chart. Okay, so click that button up there to switch from linear charting to logarithmic charting when you're looking at this kind of time frame, because, you know, during this period of time over here, it's absolutely impossible to see anything whatsoever. So that's the first thing to point out. The next thing is the composite model line takes information from the analysis and recomposes it. Now, why do I suggest turning off sigma L? Because sigma L is the sum of all the longer cycles, or anything that's unknown in the analysis. And what we want to do is we want to see what the analysis is telling us about the price movement. And sometimes when you turn off sigma L, there's very little difference, which tells us that the analysis defines a large amount of what's happening in the price action. When you turn off sigma L and you get a composite model line that doesn't seem to match price action at all, then it tells us that actually quite a large amount of that price action is caused by either unknown or non-cyclical factors or by much longer cycles. So particularly when it comes to gold, it's a very important thing to consider, because gold is known as a hedge against stock markets falling. It's strongly affected by things like inflation and economic things. It's considered a store of value. There are many things that influence the price of gold, and in particular from the late 90s, this tremendous pull up into the 2011 peak. You've got a lot of things influencing that price move. Quite a lot of things that aren't necessarily evident in the cycle analysis that we have on our chart, and that's a really important consideration. The composite model line is a very useful tool, but you must play around with it. Turn off sigma L and understand that the line that is left there, first of all, you need to clear your mind with the fact that the composite model line is giving a prediction of the future. You must not focus on that. Although it extends into the future, what's more important is the way that it shows you how the cycle analysis relates to the price movement. So I often speak about the fact that what's important about the composite model line is the structure of the line and how the cycles are showing whether price is moving up or moving down. So if I just apply a sort of a very rough sort of estimate to what this is showing, then we can see that sort of movement. Okay, and how does that compare to what is actually happening in price? Let me change the color. So price moved down, moved back up, moved down. Okay, and then it's sort of flatlined. So I hope you can see those first three legs, down, up, down, are actually matching that composite model line fairly closely in terms of structure. When the composite model line is moving down, price is moving down. When the CML is moving up, the price is moving up. However, during this period of time, there is a big discrepancy because the CML is moving up and price is effectively moving down. Then they get back into sync for this sort of period over here. Price moving down, CML moving down, CML moving up, sort of, price moving up and down and so forth. So why that discrepancy? One of the reasons why that discrepancy is there is because according to the trough analysis, and let me change this color again, according to the trough analysis, we've got a 54-month cycle trough there. Okay, and so the CML is using information from both the peaks and the troughs, and it's recomposing the cycle information from both of those analyses. So this is the important point that I wish to make about the CML. It's very important to play around with what you are including in the CML. So click on this button here. I'm sure you know how to do it, and deselect sigma L. First of all, get rid of all the unknowns. Just look at what the cycles are telling you. Then exclude troughs from the analysis, particularly when it comes to gold, because the better analysis, in my opinion, is the peak analysis. Build a CML only out of your peak analysis. Okay, and then see where you are getting discrepancies between price and the CML. That does not mean there's a problem with the CML. It means that the cycle analysis during that period of time does not accurately describe all the influences on price. And in something like gold, that is something that you will see, because gold is influenced by more things than simply the cycles. So I really hope that's useful. I hope that answers some questions. The CML is a really useful, really powerful tool, but you've got to work with it. You've got to you've got to put sigma L on and off. Look at the CML on the basis of the peak analysis only. Look at it on the basis of the trough analysis only. Try both of them. See which CML more accurately tracks the price movement. That gives you an indication of where your cycle analysis is working well and where it isn't. And then once you've used the tool to determine that, then you know what aspects of your cycle analysis to focus on. In my opinion, much better idea to focus on the peak analysis, almost to the extent of pretty much ignoring the trough analysis, because the trough analysis in gold can really just be a little bit misleading. Well, I hope you found this video useful. Have a good Tuesday, and I look forward to seeing you again soon.